Since we published our economy podcast, people have been asking me more questions about the K-shape economy. So we're going to dive into a little bit more of that on the Furlo Capital Real Estate Podcast. Yeah, where we dive into the intricacies
of real estate investing.
Yeah, keep going. You got this.
So
Real estate
together
investing.
we can improve housing and build wealth.
Yeah, sounds good.
I think I missed a section in
Yeah,
there.
it's all right. I'm James, and
Why can we not memorize that?
this is my wife, Jessie.
Maybe we spend some effort on that. New Year's resolution. Memorize the podcast intro.
Nah, we're fine.
Yeah, it's
But yeah, so hi.
Hi.
So a big
So
day
excited to talk about
for
econ.
us because our son got braces.
Talk about
So
economics.
exciting. Oh,
Cha-ching.
dude, that's not economics. That's just straight up an expense. Oh,
It's an
It's
expense.
crazy.
Oh, he's so cute though.
Yeah, he doesn't like them.
He hated
But, you know, that's okay. So, okay. And yeah, I want to talk about the K-shape economy because, again, people have been mentioning it, asking me questions about it. And so I thought it was worth just kind of doing a follow-up and diving a little bit deeper into it. So for those of you who don't know or don't remember, the idea is that it's a K-shape. So the vertical line for the K would be now, like that's times 0. And then where the legs are of the letter, that's, you know, going out in the time. And there's two legs, right? There's one that's going up and to the right, baby. And then you have another one that's going down. And so the idea being, for some people, the economy's fine. It's great. It's doing good. For other people, not so much. It's headed down. So that's what they mean by K-shape.
Honestly, I feel like our two kids' experiences with braces
Ooh.
explain this perfectly. Because
Okay.
it's like, it's virtually the same experience. They both got braces put on their teeth. But like literally watching our first one, she looked in the mirror, smiled at herself and was like, oh, ooh, cool. It's blingy. I like the colors. And then
Yeah.
our son looked at himself in the mirror and like, it wasn't even a smile. He like furled his lips so he could see his teeth and was just instantly like, oh,
Well,
like meltdown. It was just like, oh.
yes and no. You're talking about the perception of events
Sure.
and whether or not you think it's good or bad. And
I mean,
this
their
is
experience
more,
is definitely a good experience versus the bad experience.
yes, but this is more of one person. We'll stick with this analogy. I think there's better ones, but we'll stick with this one. Where one person gets on the braces and it hurts.
Ooh.
Whereas the other person, they're like, everything feels fine. It's great. I got cool colors. My friends really
So
loved
it
it.
actually is a bad experience.
Correct. Yes. Like, and the idea being, if you, and we're going to dive further into this.
That's a good distinction.
Yeah. Where like, if you are lower income and inflation is up for the core things that you buy, it's really hard.
Yeah.
If you're of the socioeconomic status where you're not worried about the price of gas and the price of food, and you maybe own a business and are able to charge more and you know, and
Offset
maybe
some of those costs.
you're like, economy's
That's fine.
great. Things are wonderful. So I'm using AI all over the place, you know, that kind of thing. So that's like, it's not just your perception, though I'll admit that is a factor for it, but they are genuinely different experiences depending on where you're at.
That makes sense.
Yeah. But no, good clarification too. So what's interesting is from a passive investor standpoint, you're not in charge of the day-to-day operations. And so a lot of the macro forces just play a bigger role in how investments
macro
go.
force.
Like those are the economy at large, right? How GDP, unemployment, population, inflation, some of those bigger pieces have a bigger influence on your investment than if you were just running it yourself. Because if you're running it yourself, you just have a lot more options and choices.
Okay.
So it's not now it's 100% on this. It's just it matters a little bit more, which is part of the reason why people are asking me about it. So what do I want to talk about? So I want to talk about where the K is showing up in Oregon specifically. So,
Okay.
Dive a little bit deeper into this.
Okay.
All right. So you have like workforce rentals versus say luxury rentals.
Okay.
So you got your studios to one, maybe two, to your 3 bedrooms,
Yeah.
you know,
With
nice
all the
homes.
amenities,
Yeah, exactly. So what's interesting for the workforce housing is that there's a lot stronger demand for that than there is for the luxury right now.
Makes sense.
Which I would say if you went back a year, that wasn't necessarily true. There was
Really?
lot of demand for that higher end,
Okay.
Class A, brand new type of stuff.
Interesting.
It's a lot less now. Historically, workforce housing rents have been growing more just because they were smaller and there was, when you have just overall increased demand, it increases everything everywhere. That for the last 6 months has not been the case. It's actually been pretty flat. It's been kind of flat across the board. And I mean, even in like the higher end homes, I've noticed rents decreasing significantly, which has been really hard conversations I've had with owners. Like, hey,
is that just because tenants can't afford to pay
that's a
certain
part of
numbers?
it. Yeah.
So they just choose something different?
Yeah. They move down market to stuff, which in theory should increase the demand for the down market properties.
Right.
But again, you're still running into like, hey, like, yeah, but I can only afford so much. Right? Like, who cares if you have an infinite demand? If everyone only has $100, like, dude, that's what you get to charge. And so we're kind of running into that problem right now, which is fascinating. It means you can be choosier on the screening side, which is kind of nice. There's typically lower volatility as well, because when on the workforce, because when someone needs to move in, like, they're there. They can't just up and move to go somewhere else. Yeah, and as opposed to on the luxury side, they're just more sensitive, like job placement and migration type of stuff, which was kind of surprised me when I was researching it. I was like, it's kind of opposite of what I would have thought. But
yeah,
I don't know.
I guess it depends on the market that you're working in.
Yeah,
maybe.
Yeah, there's other. So I guess what's important here is that supply and demand isn't the only story to this, right? The ability to pay matters just as much, because if you got people. If you are primarily renting to people who are on that lower sloped curve, it can cause issues because again, you just can't charge a whole lot more. Yeah. This doesn't matter at all to people on the podcast, but I can't tell if our kids are having a party or in a massive argument right now.
I assumed they were playing with the dog, and it was happy screams.
Let's hope that's the case. But it's screams nonetheless. We can hear it. You cannot. I'm focused at not letting it distract me, which is hard because the parent in me is like, what is going on there?
It's fine.
Yeah. Which I think a lot of investors are having out like, what is going on? What is going on? Yeah, everything's calm over here. What's wrong with you guys over there? Let's see here. And just there's some other things in Oregon that just further muddy the waters. Like there's the whole rent cap issue. So you can't increase it more than 9.9% this year. And so you get little things like that, which really get it. There's new construction slowdown, which is fascinating because that, again, increases the demand because when you don't have newer units coming in, that just pushes, and we have people coming in, just puts pressure on it. But again, it's not quite that straightforward of, we'll just keep increasing prices. Because again, there's this ability.
There's a cap on the ability they can pay.
Yeah, exactly. The other thing that I thought would be interesting to talk about would be the differences between, say, like rentals versus flips in the K-shape economy, because we do that kind of investing as well. And so I was kind of like, what is the data and influence on this? So in general, rentals behave better than flips, which I was like, okay, all right. It's not to say you shouldn't do a flip, but I'll go into why it can be a little bit more riskier.
I would have guessed the opposite.
Well, so here's the deal. With rentals, there's multiple ways to win, right? So you can get cash flow. You do have the inflation protection to a degree, especially if you have a mortgage on it. The mortgage stays the same. So as inflation goes up, your mortgage, relatively speaking, becomes worth less. And you just got time, right? You can wait it out. You're not trying to get all of your money up front, which is nice. And you can... And related to that is you can choose when to exit or not because you have a rental.
Yep.
Right? You're like, I'll just hold on to it for a couple more years, wait until interest rates do their thing.
Yeah, you don't have to sell.
Exactly. Talked about that debt advantage. I think especially fixed debt is hugely, just in general, it's better. Yeah. Whoa, excuse me. Yeah. And then why flips are a little bit riskier right now is they require confident buyers. It does require some liquidity. You got to have investors who can come in and can do it. You got to have people who can buy. And the timelines are often a lot tighter. So you don't have that, we'll just hold on to it for another year or so. And so when you get a split economy like this, it can thin out the buyer pool pretty quick because you just have less people who are able to look, especially on that lower end, which could be an issue. And you start doing discounts on stuff instead of a couple years ago, it was all bidding wars, right? It was insane what you could do, and that's just not the case anymore. And so it's just not. And the big outcome is like you sell it. Like, that's what you're trying to do. You have short-term debt on this thing. You can't just hold on to it for a couple of years.
Yep.
And so could cause a problem.
Yeah, you need to get your money back.
Yeah, so it's not that flips are bad necessarily. It's just you really got to pay attention to the assumptions and the timing going in on them. And
in this particular economy, it may be better to buy and hold.
Yeah.
Rent something out.
Yeah, exactly.
Fix it along the way with smaller amounts of money versus put it all in now because the demand's not there to buy it.
Right. Yeah.
Makes sense.
Cause an issue.
Yep.
Yeah. Can sit for a long time.
Get stuck.
You lose money. It's not a good.
Yeah.
Yeah. So I also want to talk about just affordability as a hard ceiling. So I just want to talk a little bit more about that. So again, even if supply tightens, which we've talked about, it is because they're building less. And because construction slows, more people move in, just rents can't just go up forever. That really is an issue. And I think that's especially true for the workforce housing or like those entry-level tenants. I'm pretty certain, it feels like just based on my experience, what I've seen, like they're the ones who are, quote, hurting the most.
Interesting.
On it. And so it's one of those where it's like, man, you would think like workforce housing, long-term rentals, that's the way to go. But it's like, there's still there's risk there because if I would say, don't invest in a property that's like, and we're going to increase the rents 10% every year. Yeah. Like I would not get super excited about that particular assumption at this moment.
Because in reality, they're not. You could increase them that much, but you really can't because your tenants can't pay it.
Yeah. You just have 0 people apply.
Interesting.
Which has been what I've been noticing.
So it sits vacant.
Yeah, is we've lowered our asking rents on a few places because we just don't have people applying. I'm like, oh, geez, all right. Well, okay, let's get it rented. And even like 6 months ago, it wasn't quite as bad as it was now. Now, weather also plays into everything. People just don't move during the winter, but
if there's more people still coming in and they can't afford rent, so they're not renting places, are they just finding other solutions for housing, like living with friends or moving in with family? Or?
Yeah, that kind of thing. Reconsolidating.
Living in their car.
Well, it was kind of interesting because of COVID, people spread out a lot more where you might have moved in with friends. You didn't do that anymore. And so that lower end, like the studios, 1 bedrooms, oh my gosh, those were so popular. A 1 bedroom was almost the same price as a 2 bedroom because like
there's a ton of people wanting to live by themselves.
All by themselves. Yeah. And then that
now
created, and you had families who were like, yeah, we're going to go buy our own place. We're going to move out. And so the demand just skyrocketed in addition to everyone getting all these checks and you're no longer traveling, spending money on doing some other stuff. So you had extra money in it and banks were like, let's go. Interest rates are super low. And that was what caused that massive explosion of demand. And then housing prices and everything just went through the roof. Well, now that's not quite the same anymore. Now you're like, if I'm struggling, I'll move in with friends. It's fine. Like I think those days are gone. And so you're seeing a slight retraction there, but it's still an issue. And so that's what they're doing. They're not just figuring it out. And the stimulus checks aren't a thing anymore.
Right.
Inflation is a lot higher or
people
inflation
making less.
Not higher. I want to say inflation did its thing last year or 2 years ago, right? It went way up, and now we're living in this new, more expensive world. And wages, though technically, on average, have kept pace. That's not true on the lower end side of things. Yeah, it's kind of I know. Welcome to the grim economic show.
Wah, wah.
Wah, wah, indeed. So, what do seasoned smart investors do in a K-shaped economy? I think they do a couple things. They need to segment risk more precisely, right? It's not just, is this a good market? Because that's not, it's a complicated answer.
Yeah.
Because again, if you're doing high-end stuff, it's a great market. Things are wonderful. So instead, what they ask is like, well, what economic cohort does this deal rely on? Is it that lower income or is it the higher income?
Oh, okay. Sure.
Yeah.
Because you have a totally different approach based on the clientele who you're creating it
Yeah.
for.
Or you're going to ask about the elasticity of the demand, right? Is this thing inelastic where even if prices go up, the demand's still going to be there, like gas? Or is this more elastic where if prices go up, demand's going to drop off significantly? Like, I don't know.
Like cookies
Or vacations, I guess. Yeah. And then they just ask a lot of questions. You got to stress test it, right? What does flat rents look like? And I think that's actually like borderline. That should be the assumption for most things, especially longer ones. What happens if we do have to hold onto this thing longer? Or related if the exit is a lot slower? You really want to make sure that your assumption, I mean, in general, you want your assumptions to be conservative, but in an economy like this,
even more so,
especially depending on who you're focusing on, you really want to pay attention to that. And, and then you also just want to pay attention to how the sponsor, people like myself, how they respond in the situation, right? Do their deals slow down, which ours definitely did? Do our returns compress? Because of the way we structured the deals, it did not for my investors. It did for me, but not for my investors. And then, do the markets just they just stop cooperating with the types of deals that you're trying to do?
Yeah.
So all sorts of questions. Yeah, it's kind of interesting. I was looking back at last year and the types of deals that I did. I did 3 short-term deals, kind of, yeah. But then I did 3 longer-term deals, which was interesting. Whereas the year prior, I think I did, I think I did like all 5 short-term deals. So I think that just also speaks to what numbers are, what makes sense here, what's working right now.
So you think this year you'll actually pursue more longer hold deals?
I don't know.
Depends on the deal.
To be honest, depends. Yeah, the numbers. At the end of the day, the numbers just have to pencil. I think one of the things we're going to do is we're going to double down looking for the short-term deals because we did like a quarter of what we thought we were going to do. But part of it, there were other factors like my property management company starting up,
right?
That played into it. Yeah. And so we're going to look for more of them, but the numbers got to make sense. Like we're looking at a deal right now that's in Philomath that like, man, I love the deal. It's like, it's perfect for what we want to do. We actually if we got it, we already have buyers for it. Like it's that kind of,
that's awesome.
Like, yeah. And turns out they're in the upper half of the K, but yet they want to go find a fixer upper and fix it up and make it awesome. And like, this is exactly what they're looking for, but they need to do conventional financing. This house doesn't qualify for it. So it needs someone to come in and get it to conventional.
Conventional, yeah.
Yes. We ran the numbers. So what's interesting about this one is it's actually another flipper who owns it. And he bought it for a screaming deal, which we're just like, oh, okay, we got to do more lead sourcing because that's an amazing deal. But he can't get to it. He's got too many other projects and stuff going on. So he just wants to sell it. But he's been a little greedy on the he still wants to make his $60,000. We're like, dude, you just held on to this thing.
Work.
So, and which is the difference. Honestly, what he bought it for is pretty close to what is the right number, which is hard because, again, he's trying to
make
big profit. But it's not financeable. And for me, I'm just like, oh, dude, just do our strategy. Just going to do the minor repairs and move on. But whatever. That would be our goal is we would go in, fix it up, hold it for a month, and then sell it. Be kind of the idea. Probably 2 months with all the closing time. But those are things you got to pay attention to for the sponsors. Like, how are they talking about the economy and, what
are they paying attention?
Yeah. So I got some more questions that you should ask. So again, similar, like it's not, is this a good market, but what side of the K does this deal depend on? And both are okay. You can definitely profit off of both. You just want to know what it is walking into it.
Different strategy.
Yep. You want to know if an investment still works if appreciation stalls, because that definitely could be a thing. There's a lot of people out there who are like, this is it. Like, we're going to get a correction. Like, yeah, maybe we'll see. Economy is so different now than when it was even just 5 years ago with how automated all computers and everything is. You want to know, is this cash flow durable or is it just projected? And which works a lot better for multifamilies because you can say, this is what it is. For flips or even single family homes, it's a lot harder to say because they are projections. You do want to know, what's the backup plan? if this thing
If it doesn't
goes
sell or
12 to
doesn't
24
rent,
months from now.
Yeah.
It's like we're building a house and that's our backup plan. Like, yeah, we'll just rent it out. It's fine. Turns out I have a property management company. We can just get someone in there and then we can sell it in a year or two when it makes sense. There's some conversation we'll have to have. Well, here's what's cool about it. Because of the way we structure the lending of it, we have that kind of flexibility because we're not using a hard money lender on it. And so we can talk to our individual investors and be like, would you like to just continue earning interest? We'll take a bath or we'll probably break even is my guess. Not my guess. If I'm remembering the spreadsheet right, if we have to rent it. So we won't make any money, but hopefully we won't lose any money. And then we're just like, so whatever we make, we'll give to investors. Take it, guys, take it. Will be kind of the plan there. And then again, you want to be asking about like how exposed is this deal to those affordability limits. Like that's something important that those are good questions to ask.
Yeah, if you're making super nice places that people can't afford, you're gonna lose some money.
Yeah. So, at the end of the day, what this means is that the deals that probably make the most sense are the ones that are just boring and ordinary.
Come on.
They're just...
I mean, that's kind of life.
Yeah, it's true.
Brushing your teeth every day turns out is a good idea.
Yeah, no, it's true.
Looping back to braces.
Yeah, so again, or final thoughts I should say is the economy's just weird. The K economy means that it's split. And there's just really two different experiences. And so as an investor, you just really want to pay attention to where this investment lies in there and figure out what they're doing to mitigate against it. So there you go. That's a little bit deeper dive into the K, what it means for investors, and how long do I think it will last this way? Dude, I don't know. No one knows. This could be a multi-year thing. My guess, honestly, is that it will last until the economy crashes. And then you'll watch the upper part just go,
wonk.
Right? And then, and then we'll all bounce back.
Everybody will.
Together.
Hopefully.
That's my guess. When that'll happen, I don't know. Again, there's some weird, because of computers and how fast information speed travels through things. I don't know. I don't necessarily see like the way these cycles used to working anymore, but could be wrong.
Interesting. Anyways, that's another episode.
There you go. Yeah,
what does the future hold?
That was a few weeks ago. We're good. That's where I totally prognosticate all of it. But yeah, so hopefully that was helpful. Diving a little bit deeper into that K-shape and just kind of explaining what it is. And if you did find it helpful and are interested in learning more about the types of investments we do, you can check us out at furlo.com, where you can see our investment thesis and what we do and what we're all about. So with that, thanks for listening. Have a great day.